Great. Welcome, everybody. Delighted to have you here for this latest briefing with Brooke. We are in tax season now, and so we had a taxes briefing on individual and family taxes just a couple weeks ago, and we're following up with a presentation from some great experts on Business Taxes 101. So I'm Delegate Brooke Learman, and along with my teammates, Senator Bill Ferguson, Robin Lewis, and Luke Klippinger, I'm proud to represent the 46th District in Baltimore City, though of course we work at the state level to pass and implement policies that really affect the entire state, including, of course, a number of tax provisions every year. But welcome to another briefing with Brooke, my webinars. I host these on a fairly regular basis on a variety of topics of interest to many Marylanders, and you can find my website, www.brookelearman.com/briefingswithbrooke, for a full schedule of events. We just added a couple more. We're adding a couple more to the calendar this week on anything from home ownership to education, as well as entrepreneurship. Every webinar features experts on the topic that we're discussing and gives you the option to ask questions via Facebook Live, and then we ask our experts those questions. So today I'm excited to be here to try to help folks get prepared to file taxes for their businesses. And I'm joined by two amazing women who help businesses with tax prep for a living. So why is this important? There are filing deadlines upon us in May and this summer, and regularly if you file certain kinds of taxes. There have also been so many changes to filing deadlines over the past year, as well as changes because of some of the federal laws, the CARES Act, the American Rescue Act, and whatnot. And so I wanted to bring in some experts to really help set the record straight and let you know what you can do to be prepared to file in the most efficient way. There are resources available for businesses at both the Cash Campaign website and the Community Law Center website, and there are resources available to make business-related tax payments due to COVID-19 state and federal grant programs from the Department of Commerce and the Small Business Administration. So I'm really excited to have two great people here today. Shana Roth Gormley is a staff attorney and the pro bono coordinator at the Community Law Center. She represents nonprofit clients on a variety of legal issues, including organizational structure, corporate law, and tax exemption. She works on issues related to tax sale and vacant and abandoned properties as well, and she lives in Baltimore. Betty Cole-Stamen is a CPA and is located in Columbia, Maryland. She has clients located around the globe. Betty has over 40 years as an experienced tax professional and managerial accountant and executive. She began her tax practice in 1989 and has continued to grow it through the present time. Her practice prepares complex and medium-sized tax returns of approximately 200 a year. She's also an instructor for National Association of Tax Professionals and has taught at several community colleges. And her accounting degree is from Minnesota State University in Winona. And a little known fact is that my father attended Winona State University. So it's a pleasure to have you both here today. I think I'm going to turn it over to Shana to get us started, and really excited to have you both on. Thank you so much I'm going to turn it over to Betty to get us started. So thank you so much for joining, and Betty, will turn it over to you. Thank you.
All right, thank you very much, Brooke. I appreciate the opportunity to be with your Facebook Live group today. I'm going to start out with the American Rescue Plan Act, otherwise known as ARPA. It was passed on March 11th, 2021, just about a month ago, actually. And you can go ahead and advance the screen. There's many provisions in it, and I'm going to talk both about the business provisions and the individual provisions, because if you are a Schedule C sole proprietor, your business return gets filed with your 1040. So it's important that you understand both that side of it as well as what I call the other business side of it. So let's first look at the taxpayer items that we have in ARPA. All right, so the first thing, and I'm sure everybody has heard about this, the unemployment compensation, and how are we dealing with that? All right, so up to $10,200 of unemployment benefits received per taxpayer will not be taxed. Maryland is also following in this rule. Any amount above that will be taxed. but the first $10,200 will not be taxed. So I gave you a couple examples here. We have a taxpayer who gets $7,000 in unemployment benefits. Therefore, none of it will be taxable on their federal return, which means that it will not be taxable on their Maryland return. Married filing joint return, let's look at that. We have a spouse one receives $7,000 in unemployment. Spouse two gets $9,000 in unemployment benefits. How much is not taxable? $16,000. Neither one of those spouses will have any taxable unemployment benefits. Let's look at number three. This is a little bit different. We have spouse one who gets $8,000, so all of that's going to be not taxed. Spouse two, though, gets $15,000. How much is going to be reported as not taxable on that 1040? That will be $18,200. It will be $8,000 from spouse one and $10,200 from spouse two. Because spouse one had money left over, think 10,200 minus 8,000, that money cannot be loaned to the second spouse. So this is per person, 10,200 for each person. If they receive less than that, then none of their unemployment will be taxable, but they will not be able to give it to somebody else on the tax return to use. So that was the point of that particular example. All right, next. All right, let's look at a couple other issues here that will happen. Not following the rules will cause your tax returns to be sent to error resolution section at the IRS. What does that mean? That means that a human eyes have to look at that return and process it. Guess what that does? Slows it down. There was an interesting article in the Washington Post on Sunday in the business section about how we all know they're still far behind from last year's tax filing season. This is also taking, by having to review these unemployment issues with human eyes, this is really adding a couple more weeks onto your return. So if that happens to you, it's gonna take your refund, if you're getting one, probably 4 to 6 weeks at a minimum before you're gonna see it. So keep that in mind. So you wanna follow the rules, because if you try not to, it's going to get bounced out and you're gonna end up with a longer wait and possibly some other issues. We're getting a $300 extra benefit per week for unemployment compensation, and that runs through September 6th, 2021. And a state may decide to tax unemployment benefits. They don't have to follow federal law. So if you know people who moved into a different state, Maryland law may not apply, okay? So it's really important that you know your state laws as well as your federal laws. All right, next. Now let's look at the EIP 3, otherwise known as a stimulus payment. All right, so it's $1,400 per person, which includes dependent children. And my first example is a married filing return with 2 children. And actually, they would get $5,600. I literally caught that about 5 minutes ago. So example 1, that 4,200 should be 5,600, 5600. All right, the next example, head of household. So that's 1 adult, 1 child, and 1 parent. AGI is 115,000. They're going to get 4,200 because there's 3 people. The head of household, the child, and then the parent is an elderly parent. So they each get $1,400. Last example, single return with no children, but 1 parent is a dependent. So it looks like you have 2 dependents. Okay, AGI is $85,000. They will not get any stimulus because the cutoff for a single person, for a single filed return, is $80,000. So there's different cutoffs that we have, as always, with all of the items in tax. So you have to know what your cutoff is. So here's some other information on the EIP3s. Single filing status, AGI reaches 80,000, you won't get anything. Married filing joint, your surviving spouse, and the AGI reaches 160, you won't get anything. HOH, that's head of household filing, and AGI reaches 120, you don't get anything. If you have a non-resident alien individual, they will not receive any stimulus. If you are a dependent of another taxpayer, you will not get your own stimulus. The person who claims you on their tax return will get the stimulus. And the estate or trust does not qualify. So what else happens? Well, as you're seeing on your 2020 returns, we have to reconcile how much you got for EIP number 1 and 2. Well, we're going to have to do the same thing a year from now with EIP 3. If you didn't get it in 2021 and we reconcile it on your 2021 tax return, and you should have gotten it, then you're going to get it on your 2022 tax, on your 2021 tax return that you file in 2022. Okay, so if you don't get it, but you should have, you can get it. You're just going to have to wait a year. If your 2019 tax return showed you did not qualify for it, but on your 2020 return it showed you did qualify for it, then you will get it on your 2021 tax return. But you'll have to wait another year until you can get it. So as you can see, it's very much a moving target. And if you can kind of just visualize what this is like, writing software to process all of this, this becomes very confusing. And because you're going back more than 1 year, 2019 is now considered 2 years old, it makes it more difficult, because if somebody didn't file the 2019 return, but they filed 2020, they don't have anything to go on. So it makes it very, very difficult. All right, child tax credit, advance payments, what are these? And of course, this got dumped on the IRS to put these out because they have nothing else to do. These are supposed to be sent out starting July 1st of 2021. And what they are is advanced child tax credit payments. You will be allowed in 2021 to claim, if your child's under 6 years old, $3,600 instead of the normal $2,000. If the child is age 6 or over, then they will qualify up to age 18, which is an additional year. It used to cut off at 17. They will qualify for $3,000. So they're going to be paying you half of that amount in 2021. But again, guess what? We're going to have to reconcile it on your 2021 tax return that we do in 2022. So you can see this becomes a very, very much of an interesting nightmare in some ways. We have phase out ranges here. If you're a single filer, anything 75,000 and above, you do not qualify for it. Married filing joint and surviving spouse, their cutoff is 150,000, and head of household is $112,500. Now, if you go above the phase out, you don't lose though completely, because they're going to give you the $2,000, the old amount that we used to get. And that $2,000 amount will phase out at, if you're single filing status, 200,000, married filing joint is 400,000. The old married filing joint amount used to be 185,000. So they have more than doubled that maximum amount, which will pick up a lot more people being able to claim the child tax credit, which I think is a really good thing. And as they state, their child tax credit will be reconciled on your 2021 tax return when we file it a year from now. All right, next we get earned income credit. And take a look, this is for 2021 only, the current year that we're in. So if you're a childless person, your age limit dropped from 25 down to age 19, except for full-time students. Full-time students will not qualify for this. They're being picked up on somebody else's tax return. But if you are out there working on your own, you are basically emancipated, you're not in school. If you are 19 years old, you can now qualify for earned income credit for 2021. Not for 2022, just 2021. Taxpayers age 65 and older can now claim the childless earned income credit. Prior to 2021, they could not claim it. It was not something they could do. Taxpayers may use the 2019 tax year to determine their earned income credit for the 2021 tax year if the 2021 earned income is less than the 2019 earned income. So they're comparing 2 years apart in age. And so all of that information needs to sit inside the tax software at the IRS to make sure that they can do the proper comparison. Just to give you an idea of how crazy all of these law changes are. In 2020, there were 5 major tax laws written in 9 months, which is why a lot of us are getting gray, because it was more than I've ever seen. And I've been doing this for over 30 years. It was just absolutely insane. Back to earned income credit, investment income. If you had investment income on your tax return, we have to look at those limits to see if you're qualified for earned income credit. If in the past, if you had more than $3,650 in investment, that could be sales of stock, interest, dividends, those kinds of things, you did not qualify for earned income. They have now raised that investment limit to $10,000. So a lot more people, again, are going to be able to qualify, but based on what we've been going through, a lot more people will need to qualify. Dependent care credit. Now that's different. There's so many things that are tied to the children in our lives, which is a wonderful thing, but they're all different. They all have different rules. So that makes it very confusing. No, so this again, dependent care assistance, this is only for 2021, at least at this point. The credit is fully refundable. Dependent care credit was never refundable, but it will be for 2021. The eligible expense amount, we used to get $3,000 for a child for dependent care. Think about daycare. If you've got, my grandson is just turning 5 in a month, and his daycare bill is certainly more than $3,000 for a year, because that $3,000 was for 1 year. It is now up to $8,000 for a child. So that's a huge jump, and also something very useful. Eligible expense amounts for 2 children went from $6,000 to $16,000 for 2 children. I still think, depending on where you live, that is maybe half of what it costs you to have 2 children in there. But think about what it would have been if it had still been $6,000. So it is a very good increase. Still needs to go more, but that's for another discussion. Maximum credit percentage is now 50%. The maximum you used to get for 2020 and older years was 35%. So they've increased that as well. And look at the next one. The AGI limitation increased from $15,000 to $125,000. There's going to be so many more people that will be able to count on this dependent care assistance that have never been able to before. Additionally, anybody between $125,000 and $400,000 will get a partial credit. The $400,000 limit used to be $200,000, so they have doubled that. Again, getting more people the help that they need. And this also affects how much you can have withheld from your paycheck in what we call pre-tax dollars. That means that you've not paid tax on those dollars. Before it was $5,000. For 2021, it can be $10,500. So it's double. Again, it really does help. It's not probably enough for many areas, but it at least is a much, much better needed amount. The $5,000 has never been changed from when this first came in the 80s. So you can tell it was definitely a time for all of these numbers to go up. All right, so that's dependent care. Now let's take a look at the premium tax advances. Just so you know, if you are using the marketplace to buy your health insurance, and you in the past have had to pay back your premium tax credits because you got too much help, and when we go through the reconciliation process on your 1040, we found out that you had too much, that the state helped you too much, so you have to pay it back. That is not going to happen on your 2020 tax return. No premium tax credits need to be repaid. That is huge. That is very, very huge. Also, additionally, premium tax credits in calendar year 2021 and 22 for low and middle income families will be increased, meaning you will get more help. Again, that's something that's very desperately needed right now. So that's a plus on that side for the people who have to use the marketplace to get their health insurance. All right. Student loan forgiveness. We've all heard a lot about it. So here's what's going on right now that was in ARPA. Cancellation of debt from 2021 to 2025 will not be taxable. That is huge if you've had cancellation of debt for student loans. That is huge. I'm not sure what Maryland is doing with that yet, but that's something that they will probably be looking at for sure next winter to make a decision about that. Take a look at the second bullet. Payments made after March 13th, 2021 can be refunded if the taxpayer requests them from the loan servicer. So you have a private loan with Discover, and you've been making your payments. Well, those payments are on suspension right now. And if you've been making them since March 13th of 2021, you can contact Discover and ask them to send the payments back, which would again help you with some cash flow if you needed that. Additionally, any garnishments on tax refunds or wages have been suspended through September 30th, 2021. So again, that they cannot be taking money against your student loans, either from your tax refund or through wage garnishments. But as I said, that will expire in September 30th of 2021. All right, the gig work and eBay selling. In the past, we have this form called a 1099-K, and it's issued if sales for products or services were $20,000 or more in a year. Well, ARPA changed that. You will now be getting that if you sell more than $600 in a calendar year. $20,000 last year, $600 this year. The $600 actually lines up with all of the other 1099 form items that we deal with. So I'm not surprised about this, but this is going to affect a lot of small businesses, sole proprietors who turn to various websites like Etsy to sell their wares. They now have a business and they will have to file a Schedule C. And as you can imagine, I know I did almost all my shopping online for the holidays. I went to Etsy, bought from a lot of those sellers. They now have a business and they will now have to file a Schedule C. That's huge. It's going to have them, it's going to cause a lot of issues next year for these people who are not aware that they now have an active business that is taxable. That is a huge item. All right, now let's look at the employer provisions in ARPA. Dependent care assistance. They can allow for employees to withhold up to $10,500, which fits in with the previous slide I had. And again, the old amount was $5,000. But remember, you need to find out if you've got to change the written provisions in your plan to accomplish this. If you don't change your written provisions, you may not be able to do the $10,500. Please work with your HR departments on this. Paid leave credits extended through September 30th, 2021 for sick or family leave. Sick leave in this case means you have COVID yourself. You are the employee, you have COVID. The employer there are special laws in the books on how they are to handle your payroll while you are out with COVID. And it was a 10-day, a 2-week basically time for you to get that. As you can see in the fourth bullet, qualified sick leave for employees can now be reset for a new 10-day period. Let's hope nobody gets it again, but if they did, in the old law, you only had 10 days period. That was it. Now that clock can be reset. So if you get a relapse, you would be able to get sick pay again. Family leave is not sick leave. Family leave is where you have to stay home because your child can't go to daycare because it's closed, which is actually happening with my grandson right now. His daycare had to close a week and a half ago because 3 teachers tested positive for COVID. So the entire center had to shut down. Well, my son-in-law is able to take Tuesdays off. And so he is being paid on family leave because he's required to stay home because he's got a child who can't attend daycare. So this is very, very important. If you had, say you have an elderly parent living with you, and unfortunately they get it, if you have to stay home, you can be paid, and there are provisions in the law that you can be paid family leave. And what happens from the employer side is then we have other special provisions regarding the taxes that are assessed on that leave pay. So it's very, very important. The qualified family leave wages also, they were maxed out at $10,000. They're now to $12,000. So that is also an increase as well. Employer retention credits. Oh my God. This is driving me nuts, to be honest with you, because I've found so many issues with this. This is wonderful. They're extended through December 31st, 2021. So what that means is all of your quarterly 941 reports need to be reviewed to see if they have employee retention credits. So what the government is doing is they are saying, based on several qualifications that we have to look at, including how much did your sales fall. If they fell, it used to be 50%, it is now 25%. If your sales fell off that amount in 2021, then you may qualify for federal government help to make your federal tax deposits. That's what this is about. You still have to withhold at the employee level, but the employer can get help in making their share of the payments. That's what this is about. After June 30th, 2021, so this is the quarter ending at the end of June, the employee retention credit can offset the employer's share of the Medicare tax. That's a new addition to the employer retention credits. It's really important to know that if the employer uses a payroll service for processing their payroll and their quarterly reports, the employer needs to check with the servicer to make sure they are taking the employee retention credit. And additionally, were they available to take it in the second, third, and fourth quarter of 2020? All of the 2020 returns had to probably be amended. And what I have found by talking with various payroll service providers is they're not asking their clients if they should be looking at this. They're just filing their 941s like nothing's changed. It's the employer's responsibility to contact that payroll service provider and say, hey, we need to look at the employee retention credit. I've had to do this for several clients, and we're talking possibly thousands of dollars here that can flow back to the employer. This is a very huge item. I'm disappointed that the payroll service companies have not been asking this question. They've not been asking about the sales drop off, how many employees have been had to let go or didn't come back. We have all sorts of questions we have to deal with this, but this is very important for an employer. That money can help them a lot. So any of you listening out there who use a payroll service company, you've got to get with your payroll service provider, and they need to go ahead and take care of it. And lastly, employers who use a PEO, a professional employers organization, for their payroll, they're going to have to find out how they're going to have to amend the Form 941s. I can tell you that Paychex has to do it in one fell swoop. So all of the people who use PEO through Paychex are going to have to contact their Paychex advisor and find out what they need to submit. I've had to do that for a couple people of my clients, and it's huge. And right now, we're going to be turning it over to Shauna, and there will be a Q&A afterwards. So we'll be able to finish up the rest of the slides.
Great. Yeah, thank you so much. This was wonderful. Really appreciate all this work. Very dense and really a lot of great information. So thank you, Betty. I am excited now to turn it over to Shayna, who's going to talk about tax time for nonprofits. Here we go.
Great. Thank you so much for having me, Delegate Learman, and Betty, that was really a lot of great information that I didn't know, so thank you so much for sharing all of that. So yes, I'll be talking about nonprofit tax filings, and you can go to the next slide, please. A little bit about Community Law Center. I'm an attorney at Community Law Center. We're a legal services provider for nonprofit organizations throughout Maryland. And you can go to the next slide. We cover a variety of legal issues. Tax issues are one, and I'm happy to talk more about legal advice for individual groups. So this is the overview for what nonprofits in Maryland need to have on their radar for tax filings for the year and for other filings as well. So the Maryland Form 1, which has several parts, the most important, which every business, for-profit business and nonprofit organization needs to file, is the annual report. It's the first 2 pages of the Maryland Form 1. For-profit businesses also have to file the business personal property return, and some nonprofits may have to file that part of the Form 1 as well. The second filing to have on your radar is the IRS Form 990, and the version of that form that I'm going to talk about is the 990N or e-postcard, which is for organizations with gross receipts of $50,000 or less in a year. So there's the 990 and the 990EZ for larger organizations, but for really grassroots groups, it's the 990N that you'll be filling out. And then finally, the charitable solicitation registration. So this is a filing that has to be done annually with the Maryland Secretary of State. And what they want to know is this organization or project asking for donations, applying for grants, doing any kind of charitable solicitation in the state? And if you are, then you have to do this annual registration and update. Next slide, please. So some information that you'll want to gather as you're completing these forms, your list of board of directors and officers, including their contact information, know when your fiscal year is, and this is, if you're not on a calendar year, you would want to look in your bylaws or other important documents for what your fiscal year is. Your Maryland Department ID number, so this is something that the state gives out when organizations incorporate. So you can look on the Maryland State Department of Assessments and Taxation website for this, SDAT. Your federal employer identification number, which you received when you applied for 501c3 status, you used it when you opened the bank account, copy of your important organizational documents, articles of incorporation and amendments, your bylaws, your IRS determination letter, if you have one, if the organization is a 501c3. Your bank and account number, and then some of your revenue and financial information. So the total amount of revenue for the last fiscal year, the amount of contributions you received in the last fiscal year, and amount of contributions received so far in the current fiscal year. Next slide, please. Some deadlines to keep in mind. The Maryland Form 1 filing, so the one that's required for every nonprofit, every for-profit business, that one was due April 15th. So you can request an extension, I think, up until the 15th. So if you haven't completed that one yet for the year, I would say definitely get that one in. And you will be listed, if it hasn't been filed yet for the year, the organization will be listed as not in good standing on the state website. And eventually, if you don't fill it out, the organization's incorporated status will be forfeited. So you really want to complete that one every year so you don't lose your nonprofit status. Some other filing deadlines, your state income tax filing for individuals, for business entities, July 15th this year. Charitable solicitation registration, this one depends on your fiscal year, but they've extended it till after the state of emergency is terminated. Same with some different SDAT expiration and renewal deadlines. Be aware that you, from what I have last heard, the state center office, where you can do some things over the counter usually, is still closed until further notice. So a lot of online filings are really where they're pushing folks to do those online filings now. And then some other extensions until June 30th. Next slide, please. And then some federal filing deadlines. The IRS 990 forms are due based on the organization's fiscal year. So there's no, as far as we've been able to tell, there's no deadline extension, but you can request an extension by filing a form with the IRS. For the 990N, the form for the grassroots, the organizations with $50,000 or less in gross receipts for the year, you can't extend that deadline, but you do want to be aware that you have a little bit of wiggle room. Unlike with the state, you lose your 501c3 status if you don't file 3 years in a row. So as long as you've filed at least one of those last 3 years, you won't lose your 501c3 status, but better to file every year just so that you're on track and have those filings in. And then of course, for individuals and business entities, the IRS federal income tax filing has been extended to May 17th. Next slide. All right, so going a little bit more in depth on some of the forms, and I'm happy to send these slides out. I know it's information dense, but hopefully this will be helpful if people have questions after the presentation. So the Maryland Form 1 is the first annual tax filing you really want to keep in mind. Do this every year. So every incorporated nonprofit, every for-profit business needs to be filling this out every year by April 15th. And this covers the calendar year, the previous calendar year, rather than the organization's fiscal year. And you can go to the next slide, please. So you want to do this form to avoid forfeiture, avoid losing the incorporated status for the organization. And what it's going to ask about is personal property. So it's going to ask about personal property, which is everything other than real estate that the organization owns. And for for-profit businesses, they really need to report on what all of that personal property is. Nonprofits may be exempt from some of this filing, but this form has to be filled out even if the organization doesn't own any personal property at all. So you really want to fill this out, even if the organization kind of took the year off, even if nothing happened, fill this out so you don't lose your incorporated status. If you do lose it, you'll have to file articles of revival with the state and pay a fee to get that status back. And next slide, please. All right, so you can go to that SSTAT website, the Business Express website, to find out, is the organization in good standing? Have we filed for the year? Are we on track? Did we do our filings for previous years? So you can get a lot of information about the organization here. Next slide, please. So keep in mind, this is the same form for for-profit businesses and nonprofits. So there'll be some information about filing fees. Nonprofits don't have to pay a filing fee to file this form. For-profit businesses do. So when you're filling it out, your organization, if it's incorporated in Maryland, will be a domestic non-stock corporation, and there won't be a filing fee to file this with the state. And you can mail it in, you can file it online, and I think that extension deadline has passed, unfortunately. Next slide, please. Some links to the forms. So the website has a lot of links and a lot of forms. Tried to put them all here so it's a little easier for folks to navigate. So again, we'll make sure to get this out if people have questions. Next slide, please. So a little bit about the annual report. So as I said, this is the form that every nonprofit has to fill out the first 2 pages of the Form 1, the annual report. So you're going to choose domestic non-stock corporation, provide the information about the organization, list the officers and other directors on your board, and the next slide, please. And then page 2, they're going to ask a couple of questions that this is where it might get a little tricky and you might have some questions. So the first question, and I'm sorry, the font is very small, but you'll be able to take a look back when you go to fill this out. The first question, question A, will ask about if the organization owns or uses or leases any personal property. So for this, you should go ahead and answer, do we own or use or lease personal property? And almost every organization, I think, will, because you might own office supplies, computers, equipment, books that's owned by the organization. So yes or no question there. Second question asks about a trader's license or a business license. And if you answered yes to either of those questions, that's when you may have to complete the second part of this form, the business personal property return. So then the final section, you'll just fill this out with whoever completed the form will sign. Next slide, please. Okay, so I think there's a little bit of, there could be more clarity from the state about what nonprofits need to do and who's eligible for exemption from this tax. So being incorporated as a nonprofit, a non-stock corporation in Maryland, or being recognized by the IRS as a 501c3 doesn't necessarily make the organization exempt from personal property taxes. There's a couple of exceptions that the state has said these groups are automatically eligible, and those include religious groups, so houses of worship, nonprofit hospitals, and cemetery or mausoleum companies. Those are considered automatically exempt from personal property tax. And also those organizations that all of their personal property that they own in the state had a total original cost of less than $2,500. And that's a fairly new provision. And then the third exception, if the organization has applied for and been granted an exemption from the tax by SDAT. So those are really the exceptions. Other organizations may have to file the business personal property return and provide that information about their personal property. So we've gotten some different answers from SDAT on this. Up until a few years ago, we had been told that organizations that are charitable, that are nonprofit, can just say that they are exempt from personal property taxes, write this note that you see in the bottom paragraph there on their Form 1, and we haven't seen a lot of enforcement of this, of organizations needing to get that affirmative exemption. So, I don't know if this is something that we need more clarity from SDAT on, or if it's a change in law that's needed. But for now, what we're advising is that every organization, if you don't automatically fall in one of those exempt categories, you may want to apply for the exemption. So we can go to the next slide. So again, if you answered yes to either of those questions, do you own or lease personal property or have a trader's license, you may need to complete that business personal property form. So you can go to the next slide. So the business personal property return, this is going to ask for some more specific information from each organization. And I would say also complete this form if the organization leases something like a copier. And you can go to the next slide. So it gives you an idea of some of the information that they're looking for about what the organization acquired, the value of personal property, depreciation schedule. You can go ahead to the next slide. And so it's a 4-page form, and you can go to the next slide. And then supplemental form ST1 is a fairly new thing. It may not be real relevant to most organizations this year. If it is necessary, we did include the link in one of those earlier slides. You can go to the next form, next page. So again, you want to fill this out every year. If you've missed a year, you can find the forms for previous year's filings on the SDAT website. You can sign up for SDAT's email list to get reminders about filings. And you can go to the next slide. So applying for exemption. This is a form that is on the SDAT website to apply for the exemption. And you can also contact SDAT's personal property valuation unit. I would recommend that organizations do apply for this exemption, just so that you can have that affirmative letter from SDAT saying we are exempt. There won't be any confusion about that once you apply for and get the exemption. here's what the first page of that form looks like. Great. Okay, so second annual tax filing, the IRS Form 990N. This is due for all tax exempt organizations. So if you have 501c3 status or 501c4 or another type of status, unless the organization is a church or other place of worship, make sure you're doing this form every year to keep that status. It'll be due based on the organization's fiscal year. So if you're on a calendar year, May 15th. Other funders, other state regulators might also ask, have you filed this form every year? And you can go to the next slide. Failure to file 3 years in a row, the organization will lose its 501c3 status. And that'll happen automatically. It'll be added to an IRS revocation list. While it's lost its status, the organization won't be eligible to receive tax deductible donations, and income may be subject to corporate income tax. So you really want to make sure you're maintaining this 501c3 status. If you lose it, you will have to apply again, pay the fee again. So make sure you avoid revocation by filing every year. And you can go to the next slide. Looks like it got a little bit out of whack here, but you can check the organization status on the IRS website. And then there's a little information about the different financial status that would qualify organizations to file the different versions of the form. You can go to the next slide. So filing for the current year, the 990N can only be done online. So the 990 and the 990EZ organizations can choose to file the more complex forms. But if you qualify to use the 990N, it's not necessary, and you will have to provide more information. Whereas the 990N, all you're really going to need is to provide the EIN, your organization's name and contact information, name and address of a principal officer, and to confirm that the organization's annual gross receipts are $50,000 or less. And so that would be all the revenue that the organization brings in before taking out your expenses. And then if you've missed previous years' 990 filings, from what I understand, you can't do those through the IRS website, but you may be able to use an outside service provider. And yep, you can go ahead to the next slide. One thing to keep in mind, we've seen some, I don't know if they're scams or businesses that are targeting or trying to do advertising to nonprofits, but sometimes they send a form that looks like it's from the IRS, or it's not clear about this is something that they're saying you have to file the 990N and we can do it for you for a fee. There's no fee to file this with the IRS, but there are those businesses out there that can help you file it, and they charge a fee. So, okay, I'm getting a notice we're about to end, so go ahead and skip ahead, and then I'll just briefly say charitable solicitation registration. This is something you want to do every year if the organization is asking for donations in Maryland or applying for grants in Maryland. And there may be other requirements in other states if you are doing fundraising there. So I think that may take us at least to and you can go ahead. Yep, so just some other things: keep your documents together, take notes at meetings, keep a budget, review your bank statements. You can apply for state sales and use taxes. And I think that may be it for me.
Awesome, thank you. Great, and lots of information. I don't think we've ever had two people with more information and action-packed slides, so thank you. So yeah, we are gonna have to close out, but this was great information, and we wanna make sure that everybody knows how to reach these amazing folks who do such good work. And this is just a really important topic these days, and we wanna make sure that we are lowering barriers to providing good tax advice, because this is something, we want people to be able to comply easily with tax laws. We don't want this to be a huge added expense for you. So thank you to both of you, Shayna and Betty, for your time today and for all this information. We will be sharing this PowerPoint slide, will be live linked on our website, brookelearman.com, in the section on brookelearman.com/briefings with Brooke. So folks can access the information here because it was so helpful. But a huge thank you to both of you for joining us. And everybody out there, take care, be well, and keep in touch. Thanks, everyone. Bye-bye.
Thank you.